Hey everyone, and welcome. Have you ever gotten that strange feeling that you're living in two completely different economies at the exact same time? Well, you're not crazy. Today, we're going to dive into a really powerful analysis that gives this feeling a name, the mega divergence.
So this is really the big question we're trying to figure out, right? Because on one hand, you see the headlines screaming about record-breaking stock markets and unbelievable new tech, but then, on the other hand, your own grocery bill just keeps going up and everything feels, well, a little fragile. So what is actually going on here? Let's unpack this contradiction together.
All right, to get to the bottom of this, we first have to look at the symptoms. Think of it like a diagnosis. This isn't just a hunch people have. The data shows there's a real economic fracture happening right under our feet.
And this slide just lays it out perfectly. It's like our economy is running on two different tracks. You've got the hyperspeed lane, the AI economy, where companies like Nvidia are posting just mind-blowing profits. But then, in the other lane, you have the real economy, the one making our food, our clothes, our household goods, and that one feels like it's stalling out.
So who's actually riding that AI boom? Well, the source makes it pretty clear that this economic split reflects a much bigger split in society. Just look at this number. The wealthiest 20% of families own a staggering 87% of the stock market. So when the market booms, those gains are not being shared widely, they're getting concentrated right at the very top.
But wait, how can the official government reports look so rosy while so many of us feel like we're falling behind? The source gives us this fantastic analogy. Our economic ruler is broken. The argument is that the very tools we use to measure things like inflation and growth are so flawed, the numbers they spit out can't really be trusted. It's creating this totally distorted picture of what's really happening.
Okay, so if those are the symptoms, what's the underlying disease? Well, the analysis says it's a sickness right in the heart of the entire global financial system. It's an addiction, really. An addiction to decades of easy, cheap money that is now facing a very, very painful withdrawal.
You see, for decades, Japan has basically been the world's piggy bank. It's something called the Japan carry trade. Because their interest rates were almost zero, big investors could borrow trillions of yen for practically nothing. And what did they do with it? They used that money to buy up stocks, bonds, and real estate all over the planet, fueling market booms everywhere.
And here is where it gets scary. Japan's system is becoming unstable. If they're forced to raise interest rates, that global flood of cheap money just stops. The source compares it to every single credit card in the world being canceled all at once. Imagine the panic, a desperate, frantic dash to sell anything and everything just to pay back those loans.
And this isn't some slow-motion problem. It's a potential chain reaction, a domino effect. First, the cheap money tap gets turned off. Then, everybody who borrowed that money has to sell whatever they can, stocks, bonds, crypto, you name it, to get cash. This massive sell-off creates a vacuum, a liquidity crisis, that could potentially freeze the entire global financial system.
So why is Japan so fragile? I mean, just look at this chart. The country's public debt is an unbelievable 250% of its entire economic output. To put that in perspective, that's almost double the ratio of the United States. When you have a mountain of debt that big, even a tiny increase in interest rates creates an unbearable burden. It's forcing them toward a breaking point.
Okay, so now let's connect this massive systemic risk all the way back to that booming AI economy we started with. The source uses the sector's biggest star, Nvidia, as a case study for how these huge risks can be hidden right behind the most incredible headlines.
The point here is that we have to look past the surface-level hype. The source points to several red flags. You've got a super charismatic CEO who might be distracting from the actual numbers. Then there's some creative accounting, like giving customers way longer to pay, which can suggest a struggle for real cash. There are even reports of companies just trading chips among themselves to create the illusion of sales. And maybe the biggest red flag of all, their whole business is built on tech that could be obsolete in just a couple of years, but it's being valued like it'll dominate forever.
And all of this leads to a pretty stark warning. This whole frenzy feels exactly like the dot-com bubble back in the late 90s. And the prediction here is that, just like back then, the vast majority, we're talking maybe 90% of these high-flying AI companies are simply not going to survive when this bubble eventually bursts.
So, given all that, a divided economy teetering on a fragile financial system, what in the world are you supposed to do? Well, the analysis now shifts gears into a practical survival guide for how to navigate all this chaos.
The source lays out a very specific strategy for this unique environment. It really favors tangible, real assets that you can buy with debt, like housing, and also classic safe havens like gold and silver. It's extremely skeptical of speculative things like tech stocks, which are seen as sitting on a bubble that's just waiting to pop. Now, the logic behind favoring debt is absolutely fascinating. The core idea is to take this system's biggest problem, inflation, and turn it into your biggest personal advantage. A fixed-rate loan becomes this incredibly powerful tool when the very value of the money you're using to pay it back is going down every single year. Let's just walk through how this works, step by step. You buy a house with a big fixed-rate loan, so your monthly payment is locked in. But as high inflation keeps going, everything else goes up. Your salary, the rent you could charge for the house, the sale price of the house itself. Suddenly, your fixed payment becomes a much smaller piece of your income, while the real value of that debt you owe just melts away.
So now let's pull the camera back from personal finance, because the source argues that these financial tremors are only one part of a much bigger story. They're happening at the same time as a technological revolution that is set to completely reshape society itself, the coming robot economy.
The timeline laid out here is startlingly fast. I mean, we're already seeing automation in factories. That's nothing new. But the prediction is that within the next decade, humanoid robots will become common in service jobs, in manual labor. And in as little as 20 years, most of the work currently done by humans could be automated, making the very idea of a job basically obsolete for a huge part of the population.
And that leads to the obvious question. If people don't work anymore, how will they live? And this brings us straight to the idea of a universal basic income. The source points out this isn't some sci-fi fantasy. Concepts like the family salary or al-Mashi are already being discussed by politicians in places like Turkey, as governments start to seriously grapple with what this automated future looks like.
And that brings us full circle, but with a much deeper question. In a world that's being defined by artificial intelligence on one side and broken finance on the other, what actually holds real value? Is it a brilliant line of code? Is it a piece of land? A bar of gold? Or is it something else entirely? That's the question this analysis ultimately leaves us to think about.